Hello investors, welcome to one more monthly interaction with Canara Robeco. Let us see what has happened during the last month and particularly during last few days and this week because it has been an eventful week. We'll actually have an interaction around the aspects of tariff, around the aspects of geopolitics, which is becoming more critical from a near-term perspective, and the earnings and valuation part. These are the four aspects we will cover over next 10-15 minutes. Let's start with the most important factor which is at the top of the mind today, and which is the way geopolitics is shaping up in the Middle East. While there was worry around Iran, Israel, US conflict escalating, the way it has escalated clearly has surprised us and a lot of other commentators. Generally, the consensus view was that while there will be a conflict between Israel, Iran, and US, largely the rest of the area will be out of it. But given the way it has shaped up, clearly the entire region has been kind of engulfed in the conflict. Clearly, Iran, since it is not being able to kind of fight back with the same vigor, particularly with Israel and also to US, and not create enough damage. What it has been trying to do is to actually escalate the conflict to the rest of the region and attack the refineries in most of the Middle Eastern countries, which are ally of US, as well as some of them are friendly countries to Iran too. Also attack basically the tourist centers as well as business centers in Dubai, which means to create a global impact in terms of disruptions, whether it is disruptions through energy or disruption through the travel, tourism, and businesses. Now, from our perspective, the key takeaway from this is that the clear intention is to create as much damage as possible through the energy channel, and that's something that the world can't take. The Strait of Hormuz, which carries 20-25% of the global oil, as well as Qatar, which is the single largest gas producers, both of them have actually effectively, in a way, suspended the production, or in a way the supply has halted or supply has reduced significantly in last 2 to 3 days, and that's going to have a significant impact on the way energy prices have moved. Oil has moved up almost $20 in last week or so. Gas prices in last 2 days have moved up anywhere between 20 to 50% depending on the region that you are talking about. So clearly it creates a lot of impact, which will also help Iran to push back US to stop the conflict. At this point in time, there are two scenarios that we can think of. One scenario clearly is that this conflict persisting for a longer period, I think, which will be significantly negative, because not negative from a geopolitical perspective for India or Indian markets, but more negative from the way it plays out through the energy channel, because the higher $20-25 and higher gas is something that market will not like. It will have an implications for earnings in near term. It will have an implications on the valuations. It will have an implications on the FIIs, and near term we see an impact of some of these things playing out. While the case is so, our base case still remains the second part or second aspect, which is the way basically Iran is in terms of geopolitics, except Russia and China. Nobody else is effectively very aggressively backing them. They don't have the same resources like in Ukraine, Russia, or Ukraine had over last 4 years, as in terms of whether it is defense equipments or either in terms of the financial support. And given that the top leadership is already out, at some point in time or next few weeks, we expect them to run out of the both economically and militarily to fight back. Yes, there can be a guerrilla war and they can keep creating disruption, but they don't have the financial as well as effectively ability to stay put through military infrastructure, which everything needs money, and ultimately that backing is missing in this case versus Russia, Ukraine, with which most of the people are comparing it. And that's where we're largely going with the second view, that while we will have intermittent disruption, we will have intermittent energy prices going up, it will not sustain beyond 2 to 4 weeks, and that's the base case with which we are working. If that is the case, this looks like more of an opportunity. If market were to correct meaningfully, which is what the global market reactions have been over last 2 days, and even Indian market reaction, it more looks like an opportunity from medium term perspective rather than near term perspective. Second is, I think on tariffs, we were about to be happy about most of the tariff related issues, at least are resolved to an extent of 70-80%. India had done tariff deal with Europe, and then with US, which was about to get signed. There is a Supreme Court verdict, of course, in US, so it has complicated the way it plays out. But more or less, whether it is 15% or 20%, I think that issue from our perspective is well discounted, and at least we are not going to have 50% tariff. So from trade perspective, just basic transactional perspective, I think tariff related issues are behind. Net, our view on tariffs has been, and we continue to have this view, that in a multipolar world where India actually has multidimensional economic relationships through FTA with each of the country or geographies, I think it will be a net beneficiary over medium term to play as a China plus one story as well as export story, versus the earlier regime where cost competitiveness was the sole reason for people to procure, and thus we were missing out on a lot of sectors. So those are the two global aspects. How do we expect FIIs to behave in near term, given that these aspects? Clearly in near term there will be a pressure, but also one needs to factor in that India has underperformed for last 18 months. There has been a significant outflow from India in terms of FII flows, $25 billion roughly over last 12 to 15 months. On top of that, India's premium over most of the emerging market has started to fall. On top of that, you have basically trades like cryptocurrency and even AI trade lately, like what we alluded to last 2 months. Trade seems to be kind of at least consolidating or faltering, which is what is visible in Korean market in last few days. The market has corrected 20% in just 3 sessions there, which is predominantly AI-led market. So if this were to happen, on a competing choices basis, on a bottom-up basis, India is clearly looking more attractive for FIIs versus where it was 18 months back or 12 months back or 6 months back. So that's the global piece clearly. Coming to domestic, I think most of these aspects we have been discussing, macroeconomic stability remains fairly in place. Of course, energy prices means that your current account deficit, which is about 1%, can go up in near term. But given our base case that Iran unlikely to have enough financial support to sustain for longer period, we see this more as a few weeks war as compared to few years war, which is Ukraine-Russia, where Ukraine has been backed by Europe and US consistently for last 4 years, both militarily as well as in terms of money. Given that, our sense is near term, yes, there will be pressure on current account deficit, there will be pressure on the import bills, there will be pressure on CAD, there will be pressure on currency a little bit, but we don't see it as a challenge from a macroeconomic stability perspective. Coming to the second aspect on domestic side, which is the earnings, and that's the brighter spot, as we have been alluding to, that the earnings have started to recover after a very dismal earnings for few quarters. Last 2 quarters, clearly the earnings have seen recovery. The earnings for the quarter that has gone by has already gone into double digit, almost 10% for large cap, upwards of 15% for mid cap, and upwards of 25%, 22 to 25% for small caps. Small caps higher earnings because of the base, rather than it is more statistical than the actual. But clearly the earnings have been trending up after 4-5 quarters of dismal performance, and that remains the brighter spot. And that's where the Bloomberg consensus, which is building in roughly 14-15% earnings CAGR over next 2 years, looks like more plausible scenario, unless and until this Middle East issue kind of elongates and remains around for a longer period than what we are anticipating today, which is a few weeks. If the war were to sustain for 3 months, 6 months, a year, I think clearly then it will have a macroeconomic impact through the inflation channel as well as energy prices channel, and then your earnings might also get impacted. But given the current way earnings have played out, given the way last quarter and previous quarter earnings have played out, the confidence on consensus earnings playing out to an extent of Bloomberg estimates of 14-15% remains in place. And given that market has been consolidating for last almost 15 to 18 months, also corrected lately because of the reasons around geopolitics as well as around the specific sectors like IT because of AI, the market has become relatively has come back in fair zone or cheaper zone for certain parts of the market. Large caps are looking like fairly valued or probably less than fairly valued now at current level of less than probably 18 and a half times FY27 earnings. Mid cap, small cap still continue to trade at anywhere between 22 to 25 times. Still little expensive, if but the earnings has been recovering. So let us see how earnings play out in that part of the market. But if incrementally earnings were to recover, those parts of the markets are also looking better as compared to where they were. So that's the way valuations are. So valuations earnings context is incrementally changing for last 2 quarters clearly. And if this geopolitical issue were to get resolved in few weeks, I think we'll start our journey back in terms of the market rolling over as in line with the earnings rollover. And as I said, consensus earnings rollover is anywhere between 13 to 15% CAGR over next 2 years. Given this earnings valuation context and given the near-term uncertainty because of the geopolitical issues, one can use this, in our view, as a possible opportunity to increase equity allocation. From a bottom-up perspective, given where the earnings valuation dynamics is, and our view that this war will be relatively short-lived as compared to some of the other wars with which people are comparing it, we are becoming more and more constructive if market were to keep having this volatility on the downside. So this is largely from our side for the previous month and the past week, which has been geopolitically eventful. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.